My name is Sushant and I will be teaching you leverage. So what do we mean by leverage? Leverage means that company can raise capital with the help of debt, preference shares and equity. In debt, the company has to pay interest payment. In preference shares, they have to pay preference dividend, and for equity, they pay equity dividend. Now, suppose the company has a profit, they have to pay interest. In case of loss also, they have to pay fixed amount of interest. In case of preference dividend, the dividend payment is fixed. But in case of loss, the company does not pay. But in case of profit, they pay a fixed amount. And in case of equity dividend, in case of loss, obviously they don't pay. And in case of profit, they pay or they might not pay. So that depends upon the policy of the company and how much growth they are expecting from future operation of the company. The company can raise capital through these sources and they use these capital to finance their operation. They also use this capital for some capital expenditure or investment. And obviously, when the company has a higher amount of debt, the risk of the company increase because, as you can see in the diagram, the company can go through peak phase or through down phase. In the down phase, the company might face it difficult to pay the fixed amount of interest payment. So in this point and in this point, the company, if the company has high amount of debt, they have to pay high amount of interest. And if the interest amount is high, the risk will be very high for the company. And if the risk is high, the value of the company will be lower. So higher interest or higher debt will lead to higher risk and lower value of the company. So valuation of the company and its equity is affected by the degree of debt it has. The greater debt company has, the greater chance that it can become bankrupt or greater it has risk. Highly levered company has a more chances of taking significant losses during the economic downturn. They have to face financial distress. When I say financial distress, I mean they might miss some opportunity regarding capital investment, or the supplier will not provide them any type of credit. And eventually, if they default on the principal amount, then the company can be declared bankrupt. And all its assets will be sold off and they will be given to debt holders, preference shareholders, and then in the last, it will be given to the equity holders. So this is the hierarchy of the payment of the selling of the asset. Now let's talk about the cost structure. The cost of a company is divided into two parts. Cost, that is the variable cost, and the fixed cost. Variable cost that vary with the level of production. If I produce 1000 units, the cost will be, let's say, 2000. But if I produce 20,000 units, then my cost will be 40,000. So it varies with the amount of production. Fixed cost that remains same. So if I produce 1000 quantity, let's say my fixed cost is $10,000. And if I produce 20,000 quantity, still my fixed cost will be 10,000. So cost that remain at same level regardless of the amount of production. Now this chapter further talks about the risk. The risk of the company can be divided into business and financial. The business is in regard to the profit. That is, their operating profit, that is profit from the core operation, tends to be very highly volatile. The reason for this highly volatile can be sales, second operating risk. Now sales risk. The sales is very highly volatile. That is, the amount of revenue is highly volatile. The reason for amount of revenue is highly volatile could be the quantity sold is very few. Sometimes you sell very high amount of quantity. Sometimes you sell very low amount of quantity, or the price which you are charging per quantity is very low. If you are not able to charge a high amount for the goods which you are selling, then your sales will be highly volatile. Now let's talk about operating risk. Operating risk, we are talking about the fixed cost that the company has. Now the reason that the company has volatile operating profit might be due to high amount of fixed cost. Fixed cost, I mean fixed operating costs. That can be rent, that can be salaries of the employees, that can be fuel costs, raw material costs. So these are basically my fixed operating costs. And for the financial risk, if the company has taken more debt, they have to pay higher amount of interest every year or every quarter, and the financial risk will be very high. So it is dependent upon the payment of interest. If the interest payment is very high, the financial risk will be very high. Now let's go through this income statement. Suppose a company is selling a unit. It is selling it for $10 and the variable cost is $2 per unit. Suppose the company has sold 1 lakh unit. Its sales will be, in terms of dollars, 10 into 1 lakh, that is 10 lakh. And if the variable cost is $2, the variable cost amount will be 2 into 1 lakh, that is 2 lakh. Now I subtract variable cost from sales, I get contribution margin of 8 lakh. From this I reduce my fixed expense. Fixed expense, like I said it before, rent and salary and so on. Let's say it's 5 lakh. I subtract it, I get operating profit. Also we sometimes refer to it as EBIT. Of course there is slight difference between operating profit and EBIT. For the time being, we just refer to it as EBIT. Less interest payment of 1 lakh, and then we get the net profit of 2 lakh. Now next, so we have covered this part, business risk. That is the risk regards to your operating profit, because revenue, either the revenue or expenditure regarding to those revenue are very uncertain. That is why there is a high amount of business risk. So this was divided into sales risk, that is uncertainty of revenue, and this is due to quantity of goods, that the quantity of goods which you sell was very less, or the price you were able to charge is very low. And operating risk, it basically arises due to mix of fixed and variable costs. So when you have very high amount of fixed cost as compared to variable cost, you have high amount of operating risk, and this will affect your operating profit. Now this is a term that this is highly testable. So degree of operating leverage is the sensitivity of your operating profit to changes in sales. That is, if I say my DOL is 2, it means if my sale increase by 10%, my operating profit will increase by 20%, and the vice versa. That is, if my sale decrease by 10%, my operating profit will decrease by 20%. Now why we are trying to compute the DOL? DOL, if I am comparing two companies, let's say company A and company B, if the company A has a DOL of 2 and company B has a DOL of 4, company B is more risky. That is, the reason for it is that if the sales of company decrease by 10%, its profit will decrease by 40%. But in case of company A, if its sale decrease by 10%, its profit will decrease by only 20%. So higher the DOL, higher the risk of the company. Their profit tend to fluctuate a lot. So we can look at with the help of this example. So let's say the revenue was 10 lakh, variable cost was 2 lakh. So we got contribution margin of 8 lakh less fixed cost, and then we get operating profit. Let's say our sales increase by 10%. In this scenario, my revenue will be 11 lakh, variable cost will increase, so it will be 2,20,000. So there will be 10% increase in the variable cost, but my fixed cost will remain the same. There will be no change, because fixed cost does not vary with the changes in the sales amount. And my operating profit, if I compute 8,80,000 minus 5 lakh, that is 3,80,000, and my operating income is 3,80,000, and the percentage change in the operating income is 26.67. So if my sales increase by 10%, my operating income has increased by 26.67. So I can easily say my DOL is 2.667. And if I want to compute it without making these tables, the formula for this is DOL equal to contribution margin divided by operating profit. My contribution margin was 8 lakh and my operating profit was 3 lakh. And if I solve it, I get 2.667. Same value which I was getting. This was the amount 2.667. For the financial risk, it arises because the company has taken a loan from the bank or the company has issued bond to the investors. So when they issue the bond, they sign the financing agreement with the investors, known as bondholders. So these bondholders, they have given money to the company, and the company is obliged to pay these bondholders interest every year. So financial risk is the risk that arises from company's obligation to meet its required payment under the loan agreement or the financing agreement which they have made with the bondholders or the bank. Now for this, to compute this, to measure this, how levered the company is, we measure the degree of financial leverage, which is how my net profit will change with the changes in my operating profit. So that means if my operating profit increase by 10%, and if I say my DFL is 3, then my net profit will increase by 30%, and the vice versa. So it's a sensitivity of a net profit to changes in the operating profit. Now we can try to compute it with the help of this example. Let's say my operating income was 3 lakh minus interest payment, that is fixed amount of 1 lakh. We get net profit of 2 lakh. Let's say my operating income increased by 10%, that is 3,30,000, but my interest will remain fixed 1 lakh, and I get 2,30,000. Now if I compute the change, it is 15%. So my operating profit has increased by 10%, but my net income has increased by 15%, that is 1.5 times. So my DFL is 1.5. Again, the formula for this is DFL is equal to operating profit divided by net profit, that is 3 lakh divided by 2 lakh, that is 1.5. So I'm getting the same answer which I was getting here. Now the total leverage. Total leverage basically combine both the leverage, that is DOL and DFL. So DTL is equal to DOL into DFL. So if I open up the formula, DTL is equal to, the formula for DOL was contribution margin divided by operating profit, and the formula for DFL was operating profit divided by net profit. These two cancel out, and I get contribution margin divided by net profit as my formula. So I have taken the same example. So if you remember, my contribution margin was 8 lakh and my net profit was 2 lakh. That is, my DTL is 4. So 10 lakh minus 2 lakh, 8 lakh is my contribution margin, and my net income is 2 lakh. And if you see, I'm getting a DTL of 4. So it is my sensitivity of net profit with the sales. That is, if my sales increase by 10%, if my DTL is 4, then my net profit will increase by 40%. As you can see in this example, my sales has increased by 10% and my net income has increased by 40%. That is my DTL. And here's the formula, contribution margin divided by net profit, and that's how you can solve it. So you can be asked both the ways. So first is the contribution margin divided by net profit. The other way to do this is the value of DOL and DFL. My DOL was 2.667 and my DFL was 1.5. I get the same value. So 2.66 into 1.5, my DTL will be same in both the cases. Now let's talk about break-even point. Break-even point is that quantity at which my total revenue become equal to my total cost. That is the quantity, how much quantity I must sell so that I'm able to cover my cost. So what is the quantity in terms of unit I need to sell? The formula for this is, for the break-even quantity, my total fixed cost divided by price per unit, that is the amount that I will get by selling 1 unit minus variable cost per unit. So if I look at the example, it was price is $10, variable cost is $2 per unit, and my fixed cost is fixed cost of operating as well as the interest cost. So don't forget to take the interest cost as well. So total fixed cost is 6 lakh. And the price per unit is $10 minus $2. If I solve it, I get 75,000. And we can also check it. If my unit sell is 75,000, my revenue will be 7,50,000. My variable cost will be 1,50,000. So I get my contribution margin equal to 6 lakh. My fixed expense will be 5 lakh. My operating power will be 1 lakh. And my fixed interest is 1 lakh. I get 0 as my net profit. So this is my break-even quantity in terms of units, and this is my break-even quantity in terms of dollar amount. So this is it.